Stop what you're doing for just a moment because the silver market is standing at a crossroads, and very few people are talking about how extreme this moment really is. Right now, two completely different futures are staring investors in the face. In one scenario, silver pushes higher, breaks through major resistance, and begins a powerful run toward $130 and beyond. In the other, this rally stalls, momentum fades, and prices tumble in a sharp correction that catches late buyers completely off guard. Both outcomes are possible. And that's exactly why this moment is so dangerous. When markets reach a turning point like this, emotions run high. Optimists see nothing but opportunity. Pessimists warn of a top. But markets don't move based on opinions. They move based on positioning, momentum, and psychology. And right now, those forces are pulling silver in opposite directions. On one hand, the long-term story behind silver has real strength. Industrial demand continues to grow. Investors around the world are looking for protection against economic uncertainty. Silver plays a role in everything from energy technology to electronics, which gives it both industrial and monetary appeal. That combination can create powerful bull markets. But here's the part many investors forget during strong rallies. Price doesn't just reflect the story. It reflects expectations about the story. And when expectations rise too fast, the market can become unstable even if the long-term outlook remains solid. That's where we may be today. Silver's recent surge has attracted a wave of new interest. More attention brings more buyers. More buyers push prices higher. Higher prices attract even more attention. It's a feedback loop, and feedback loops can overshoot reality in both directions. If momentum continues and confidence stays strong, silver could absolutely make a run toward $130. Big round numbers like that act like magnets in markets. They draw attention, headlines, and speculation. But if momentum weakens or a negative surprise hits, the same emotional energy that pushed prices up can flip, sending them down just as quickly. This is what we call a risk dichotomy. A market split between a breakout and a breakdown. And those moments are where the biggest gains and the biggest mistakes are both made. In this video, we're going to break down both sides of the equation, what would need to happen for silver to reach $130, and what warning signs could signal that a correction is coming instead. Not hype, not fear, just the mechanics of how markets behave at critical turning points like this. Because when silver finally chooses a direction, it probably won't move quietly. It will move fast. And the investors who understand the setup ahead of time will be in a much stronger position than those reacting after the move has already begun. To understand why silver could realistically move toward $130, we first need to look at what's been driving this market higher in the first place. Strong rallies don't appear out of nowhere. They are built on a combination of real demand, investor behavior, and broader economic forces that all line up at the same time. One of the biggest factors behind silver's strength is its dual identity. Silver is not just a precious metal like gold, it's also an industrial metal used in technology, renewable energy systems, medical equipment, and electronics. As industries modernize and expand, silver demand for manufacturing and green energy continues to grow. That creates a steady base of usage that didn't exist at the same scale decades ago. At the same time, silver benefits when investors feel uncertain about currencies, debt levels, or financial stability. During periods of global tension or economic stress, people often look for tangible assets that are not tied directly to the banking system. Silver, being more affordable than gold, becomes an accessible entry point for many investors seeking that kind of protection. When industrial demand and investment demand rise together, price pressure can build quickly. Another factor supporting higher prices is momentum itself. Once a market establishes a strong upward trend, it attracts technical traders and funds that follow price patterns. These participants don't necessarily focus on long-term fundamentals. They focus on direction. As long as the trend stays intact, they keep adding exposure, which can extend rallies beyond what traditional valuation models might suggest. We also have to consider the role of inflation expectations. When people believe the cost of living may continue to rise, interest in hard assets tends to increase. Even small shifts in how investors view future purchasing power can redirect large pools of money into metals. Silver often moves more dramatically than gold during these phases because its market is smaller and more sensitive to new flows. All of these forces together create the kind of environment where ambitious price targets start to feel realistic. Once silver moves strongly enough, the conversation changes from can it go higher to how high can it go? That's when numbers like $120 or $130 start entering the discussion. Big, round numbers act like psychological milestones. They attract attention, media coverage, and new speculation. If silver pushes through previous resistance levels with strong momentum, traders may begin targeting those higher levels simply because the trend appears powerful and self-sustaining. But here amongst the important part. The same factors that can fuel a surge can also create vulnerability if momentum fades. Strong trends invite crowd participation, and crowded trades can reverse sharply when conditions shift. That's why understanding the bullish case is only half the story. Now let S turn to the other side of this critical moment. The warning signs that silver may be running too hot and could be vulnerable to a sharp pullback instead of a smooth move toward 130. Markets rarely ring a bell at the top. Instead, they leave clues. And when rallies become steep and emotional, those clues often show up in subtle but important ways. One of the first signs is the speed of the move itself. Healthy bull markets usually climb in waves. Up, pause, up again. But when price starts accelerating faster and faster, moving almost vertically on a chart, it can signal that emotion is overtaking discipline. That kind of acceleration is often driven by late buyers chasing performance rather than steady long-term accumulation. Another warning sign is increasing volatility. During the strongest part of a rally, price swings often get larger. Big up days are followed by sharp pullbacks, then another push higher. While this can look exciting, it also shows the market is becoming less stable. Strong hands may be quietly selling into strength while newer participants buy at elevated levels. We also have to watch how silver reacts to news. In powerful trends, good news pushes prices up strongly, but near potential turning points, even positive developments may fail to generate sustained gains. If headlines that once would have sparked big rallies start producing muted reactions, it can mean buying power is being exhausted. Sentiment is another key factor. When nearly everyone you hear from is bullish, risk tends to be higher than it appears. Markets need new buyers to keep rising. If most interested investors are already positioned, the pool of fresh demand shrinks. That leaves price more vulnerable if selling pressure emerges. Positioning data can also become stretched during strong rallies. When speculative traders hold unusually large long positions, it means many participants are already committed to the bullish side. If price dips, these traders may rush to exit, amplifying the decline. Crowded trades often unwind faster than expected. Then there's the psychological factor of late entry. As silver climbs, investors who hesitated earlier may finally decide to jump in, afraid of missing further gains. These late buyers typically have less tolerance for volatility. If price drops suddenly, they may sell quickly, adding to downward momentum. None of these signals alone guarantee a crash. But when several appear at once during a steep rally, they create a fragile environment. Markets can stay strong longer than expected. But once momentum breaks, reversals can be swift. That's the danger of a risk dichotomy moment. Confidence and vulnerability exist side by side. At major turning points, markets often look strong right up until the moment they change direction. That's why understanding potential triggers matters so much. Silver doesn't need a disaster to pull back. It just needs a shift in expectations. One of the most important influences on silver is the US dollar. Precious metals often move in the opposite direction of the dollar. If economic data comes in stronger than expected or central banks signal tighter policy, the dollar can strengthen. A rising dollar can pressure commodity prices by making them more expensive for global buyers. Even a moderate currency move can cool momentum in a market that has run ahead of itself. Interest rates are another key factor. When investors believe rates will fall or remain low, metals often benefit. But if inflation proves stubborn or policymakers hint at keeping rates higher for longer, bond yields can rise. Higher yields make income-producing assets more attractive compared to metals, which do not pay interest. That shift can lead some investors to rotate out of silver and into other assets. Profit-taking by large investors can also act as a catalyst. Funds that bought earlier in the rally may decide to lock in gains, especially if prices approach widely discussed target levels. These investors often sell gradually, but once price momentum slows, their selling can become more visible and influence sentiment. When major players start trimming positions, others tend to follow. Geopolitical developments can have an impact as well. Silver often attracts safe haven interest during times of global tension or uncertainty. If risks appear to ease or markets perceive reduced instability, some of that defensive demand can fade. Without that extra layer of buying, price support can weaken. Industrial demand expectations are another piece of the puzzle. Silver is used in manufacturing, electronics, and energy technologies. If economic growth forecasts soften or industrial activity slows, expectations for future silver usage may be revised downward. Even small changes in outlook can influence price when markets are already stretched. And then there's simple market mechanics. During strong rallies, many traders use leverage or tight stop-loss orders to manage risk. If prices begin to slip, those stop orders can be triggered automatically, adding to selling pressure. This chain reaction can turn a modest dip into a sharper correction than fundamentals alone might justify. None of these triggers have to be dramatic on their own. The real risk comes from how they interact with an overheated market. When silver finally shifts from rally mode into correction mode, the change in tone can be dramatic. What felt like a steady climb can quickly turn into a fast slide. and the speed of that move often surprises even experienced investors. One of the defining traits of silver is volatility. Because its market is smaller than gold's and attracts a mix of industrial users, long-term holders, and short-term traders, price movements can become exaggerated once momentum turns. Gains can be rapid, but losses can be just as sharp. Corrections rarely begin with panic. They usually start quietly. A strong day fails to follow through. A dip lasts a little longer than usual. Buyers who once rushed in immediately begin to hesitate. That hesitation is the first sign that confidence is weakening. As price drifts lower, short-term traders who bought for momentum may begin to exit. Their selling adds pressure, pushing prices down further. This can trigger stop-loss orders placed by other traders. These automatic sell orders accelerate the decline, turning a normal pullback into a sharper move. At the same time, late buyers, those who entered near recent highs, may feel uneasy. They were expecting quick gains, not sudden losses. If the drop continues, fear can replace optimism. Instead of asking how high silver can go, investors start asking how much further it could fall. That emotional shift often happens quickly. In volatile markets, a 5% decline can become 10% in a short period. 10% can stretch to 15 or 20 before the selling pressure finally slows. Moves like this feel extreme in the moment, especially after a period of steady gains. But they are not unusual in assets with silver's history of sharp cycles. Leverage can intensify the process. Traders using borrowed money may be forced to reduce positions as prices drop, regardless of their long-term outlook. This forced selling can push prices lower than fundamentals alone would suggest. What makes these corrections particularly challenging is how fast they develop. When markets become volatile, the difference between reacting emotionally and responding strategically becomes incredibly important. Silver AES risk dichotomy, the possibility of a push toward 130 or a sharp correction, is exactly the kind of environment where disciplined investors separate themselves from the crowd. The first principle experienced investors follow is simple. They do not let a single market move define their entire financial future. Silver may be an important part of a portfolio, but it should not be the only pillar holding everything up. Proper balance helps ensure that even if silver experiences a sudden pullback, the overall financial picture remains stable. Position sizing plays a major role in this. When an investment is sized appropriately, normal market swings remain manageable. But when a position becomes too large, every price movement feels magnified. That emotional pressure often leads to poor decisions at the worst possible time. By keeping exposure at a level that allows clear thinking, investors give themselves room to navigate volatility calmly. Another key strategy is planning ahead. Instead of trying to make big decisions in the middle of market turbulence, seasoned investors think through possible scenarios in advance. What would they do if silver moves higher quickly? What would they do if it drops sharply? Having answers prepared reduces the risk of panic-driven choices. Liquidity is also valuable during uncertain periods. Holding some cash or lower-risk assets provides flexibility. If silver corrects, liquidity offers the ability to respond thoughtfully rather than feeling stuck. Diversification adds another layer of resilience. Markets do not all move in the same direction at the same time. As silver stands at this crossroads, it's easy to get pulled into extreme thinking. Some voices insist prices are destined to surge far higher without interruption. Others warn that a major collapse is inevitable. But markets rarely follow simple, one-direction stories. They move through phases, often surprising both optimists and pessimists along the way. What makes moments like this so challenging is the emotional intensity surrounding them. When prices move strongly, headlines become louder, opinions become more confident, and investors feel pressure to act quickly. That urgency can cloud judgment, especially for those who feel they might be late to the move. Stepping back helps restore perspective. Silver's history shows cycles of powerful rallies followed by sharp corrections, then periods of consolidation before the next big move begins. These cycles are not signs of failure. They are part of how markets reset and build energy for future trends. Understanding this cycle helps investors avoid emotional extremes. If silver pushes higher toward ambitious targets like $130, that doesn't automatically mean it will keep climbing in a straight line forever. And if it corrects sharply first, that doesn't automatically mean the long-term story is over. Both outcomes can exist within a broader trend. Another important perspective is time horizon. Short-term traders focus on days and weeks. Long-term investors focus on years. The same price movement can look like a crisis to one group and a normal fluctuation to another. As we come to the end of this discussion, one thing should be clear. Silver is at a moment where both opportunity and risk are elevated. The possibility of a move toward $130 exists, supported by strong demand themes and powerful market momentum. At the same time, the risk of a sharp correction is real, especially after a fast and emotional rally. This is not a contradiction. It's the nature of markets at critical turning points. When prices rise quickly, optimism grows. When optimism grows, expectations rise. And when expectations rise too far, Even good news can fall short of what the market has already priced in. That's why major moves, in either direction, often happen when confidence is high and caution is low. The goal is not to predict the exact path silver will take next. The goal is to understand the environment and position yourself in a way that allows you to handle different outcomes without being forced into emotional decisions. If silver continues higher, discipline helps ensure that gains are managed wisely rather than chased recklessly. If silver pulls back, preparation helps prevent fear from driving rushed choices. In both cases, awareness provides an edge. Markets are emotional in the short term and logical over longer periods. Recognizing this pattern helps reduce the shock when volatility appears. Silver's next target may be $130, or the market may need to cool down first. Either way, clear thinking will always be more valuable than crowd emotion. And in moments like this, clarity is your greatest asset.